This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's move on and look at bonus issues and rights issues. Now, if you've watched and dealt with the 3 chapters on capital gains, you will recognise these 2 issues. We have discussed them before. They are very similar to the rules for individuals. The bonus issue simply increases the number of shares held. There's no increase in cost, therefore it is not an operative event. It is not an operative event. There is no need to index. Okay, you just simply add them in because you've just had more shares. It waters down the value of those shares. However, a rights issue, if you remember from before, it increases the number of shares held, but there is also a cost associated because they've bought them in a favourable manner, normally at below market value. And the question will tell you how much per share they have. You're going to have to work out how many they've had, but then they will tell you how much they are worth. So that is an operative event, and therefore that needs to be indexed. So let's have a look at example number 3. We've got some shares here. He bought 3,000 shares in July 94 for 10,000. And then in February 96, they made a 1-for-3 bonus issue. And then they sold some shares in March 2023. Got some indexation factors here that need to be dealt with. So let's have a look at how this works in a model answer, because the process is exactly the same as the one that we have just been through. So example number 3, the first thing you always do is match the shares. Did we buy any on the same date? No, we didn't. Did we buy any on the previous 9 days? No, we didn't. So all our shares are going to come out of the share pool. So that is important. Always show that you know the rules. Okay, so a pool needs to be constructed. 3 columns across the top. We need this indexed one because that's going to have the indexation in it. And the pool contains all the shares that have been bought that haven't been matched in the order in which they are bought. So in July 94, we bought 3,000 shares, cost us £10,000. Cost goes in both columns. Bonus issue, 1-for-3. We've got an extra 1,000 shares. No cost, no indexation. It is not an operative event. See the note I've put here for you. No indexation of the pool. Though the examiner may still give you the indexation factors to that date. Don't be fooled. Bonus issues, no indexation. Subtotal your columns, and then we need to index from the start of this pool up to the date of a sale. So it's the indexed cost figure that we are indexing. This has come from the question, giving us an extra 9,910. Subtotal, again, always subtotal as you're going along. Now the sale of the shares, we need to deduct 2,000 of those. So it looks like that's half of the pool. So half of the cost and half of the indexation cost. Remember, that is cost plus indexation, which needs to be split in our model answer. So this is our answer. Make sure you put in your heading, because those 2 that you've just done, those are workings. But your workings get marks. Marks get you past the finishing line. Proceeds from the question less the cost, less the indexation, gives us a gain of 2,045. Next page, takeovers. Again, this is a repeat of previous information. So please, you should have done the capital gains tax chapters before you did this chapter. So a repeat here, we've got a repeat, these are repeats. Where the takeover is share for share or paper for paper, it does not constitute a chargeable gain. Basically, you swapped one piece of paper, blue shares, for red shares. No cash, no tax. Mixed consideration is where there may be different kinds of shares. If it's still paper for paper, you had red ones before, now you've got blue and green ones. The cost of these blue ones needs to be allocated between the red ones and the green ones. And we did a step process previously to this. Do you remember the step process? What did he have originally? Step 2, what did they get in the takeover? 3, what was the value of those shares at the time of the takeover? And therefore you need to allocate the cost according to the valuations. So we're going to have a look at example number 4. Z Limited had 10,000 shares in A Limited. The shares, he bought them in August 89 for £10,000. Now, July 2022, there was a takeover and he got 2 ordinary shares valued at £1.50 each and 1 preference share valued at £1 each. And then the preference shares are going to be sold. And we've got another indexation factor there. Calculate the gain resulting in the takeover and the sale of the shares that we need to look at. Okay, so we are going to have a look at dealing with this. What did he have before? What did he have after? What was the value at the time? And then allocate the cost. Those are your 4 steps. And we did them in quite a lot of detail in the capital gains tax chapters. Okay, let's have a look at the model answer. It says, as the terms of the takeover are share for share, no gain will arise at the time of the takeover, with the new shares taking on the original cost of the old ones. Okay, and we're going to use the market value of those shares as a basis for dividing the cost. So it's a repeat of what we've done before. So he's had 10,000 ordinary shares and they're going to get 2 for each one of those. And they were market valued at £1.50 each. So the value of those new shares at the time of the takeover is £30,000. Also getting some preference shares, and they are valued at £1 each. So £10,000 is the values. This is the total value at the time of the takeover. Now this cost is from the question. That doesn't change. Basically, the A shares are now the same cost as the B shares, and we're going to use these values here in order to allocate that cost to each one of those. It's a working that you need to show. It's a process that you need to explain to the examiner, that you understand how that has worked. So the gain on the sale of the shares, proceeds, that came from the question, the cost, that came from your working, and then we've got this additional thing here, the indexation of the cost that factor has come from the question, giving us a gain of £9,107. If you're unsure about this and it seems to be going in a way that you don't understand, then you need to go back and do the capital gains tax chapter, because we did it in great detail there. Did lots and lots of different examples so that you could then work it through. And again, the step process is there. The more times you take that information in, the more synapses work, the easier it will become for you to understand. Now, if you remember from that chapter, if we see cash, then there is a gain at the time, and that needs to be dealt with. So what we're going to do is we're going to look at example number 5, which is example number 4, but instead of getting preference shares, we've had cash. So let's have a look at our model answer, which follows exactly the same process. So what did we have before? What did we have after? And we've got cash now, and that's the cost. Again, we've used this element of value in order to allocate the cost. Now, it's the cash that is therefore going to be subject to a chargeable gain. Proceeds came from the question. The cost comes from the working that you've done. And then there is the indexation factor from the question times the cost gives us £3,392, allowing us to calculate a chargeable gain of £4,108. Now, when you finish this chapter, I would suggest, because hopefully you've done the capital gains for individuals, the rules are more or less the same, the processes are the same, the rules are slightly different with the matching rules and the takeover rules and the little bit of indexation. Everything else is the same apart from that. Do the chapter on shares for individuals, do the chapter here on shares for corporation tax, and then do the practice question. If you're still not happy with it, watch it again, keep doing the examples, and when you're happy with it, go to your BPP revision kit and do a couple of examples there just to make sure that it's well fixed in your head.